Oh boy, welcome back to another Stock Market Open live stream. Today on the main channel, by the way, we've got a Tesla video coming out that'll be pretty good. It'll be on the Tesla valuation projections, so I think that'll be pretty exciting to see, and we'll go forward a little bit in terms of time, so it'll be fun. All right, so what do we have for El Market today? Well, it is Friday. I don't know. Fridays are always bittersweet because it's kind of like there's no trading on the weekend, so it's like, what am I gonna do? You open up your phone, it's like, that's right, it's a weekend, and there's no data, so it gets I don't know, boring. But anyway, today we do have we get a little bit of housing number data. We're gonna get housing starts. We'll get building permits. We'll get some of that good stuff in about 3 hours. I'm not on East Coast. Maybe I'm on East Coast time here. Let's see here. -5. Oh, actually, no. I'm sorry. We're gonna be getting that in 3.5 minutes. Okay, very well. So we'll get that in 3.5 minutes. So that'll be cool. We'll get to see that together. You've got Volvo shares down over oh my gosh, as Chinese owner Geely sells off stock. Autos is tough. It is a tough industry to be in right now, and it's all based on rates. It's great because Goldman said the other day, basically nobody's close to Tesla in terms of their ability to actually make a profit in EVs, and that could not be more accurate. I think a lot of people forget that. Is that people love or hate Tesla. They're the ones who figured out how to make money selling electric cars. Nobody else really has. You've got the 10-year Treasury is about to drop below 4.4. If we stay on this trend today, we'll probably be in the 4.3 range. Boy, we have not seen 4.3 since Bill Ackman first shorted Treasuries. Bill Ackman shorted Treasuries at right about 4.2. And they probably ran to 4.3, then dropped to 4, and then ran all the way to 5. And of course, they ran to 5 because he said they were going to go well past 5. And then as soon as they got to like 4.99, he dumped and covered. But that's classic. I mean, that's what the institutions do. It's manipulate the market, but do it illegally. Anyway, crazy. So now the question's going to be what are we? Well, first of all, regarding this housing data that comes out, I wouldn't be surprised for this housing data to not be that great, mostly because we are kind of, the last month for housing, September to October weren't that great. Some of the comps were great, like houses sold for higher prices, but during the months of September and October, the market hit a wall in a lot of different areas, and so you'll actually end up getting lower sales probably November, early December, and that's starting to pick up again as rate enthusiasm is going up. It was very, very much aligned. I noticed just the competition was very reactive to interest rates. As soon as we got a good CPI report, it felt like the competition kind of ratcheted it up a little bit, which is very entertaining to see how quickly even home buyers or investors, mostly investors that we're competing against, where very few home buyers were competing against. But anyway, it's very interesting to see how quickly the investors were attuned to interest rate changes. You expect that a lot more in the stock market than you would here. Okay, so we are now about 15 seconds or so from this housing data. So again, we're looking for about 1.35 million in housing starts. And that's actually breaking ground, and 1.45 in permits, going to the office and pulling a permit and starting to get the architectural stuff going. And okay, wow. So we actually got a little bit of a beat on both of those numbers. Wow, that's actually surprising. 1.372, 1.487, and then housing starts and building permits. Both of those were expected to be negative. They actually both came out positive. We were looking for negative 0.6 on starts. We got 1.9%. We were looking for negative 1.4 on permits. Got 1.1. Well, that's interesting. The builders. This is despite, I think, yesterday home builder optimism dropped to like another decade low. But I've noticed this cycle, the data has been so volatile just on everything. I mean, maybe that's true in every cycle, but I don't know. It's COVID, I think the data was pretty much one direction. One direction and then one direction. We had the little inflection point. You had your V-shaped recovery. Interesting. What is this here? No. Oh, this is just talking about IBM. Oh, okay. There was just there's this headline piece on the New York Times, which is the New York Times for what it's worth. But I know a lot of people don't like the Times. I actually think they have some good research frequently, actually. X races to contain damage after Elon Musk endorses anti-Semitic post. There's really nothing new there in the article, it doesn't look like, other than the fact that IBM withdrew advertising like instantaneously, which is not good. I think at this point, people have almost come to terms with Elon's commentary. I don't know, though. We'll see. We'll talk about that in the Tesla video. So, okay, good. Let's see here. Talking about the Fed here, we've got Fed officials. Let's see here. Okay, what does this talk about? El Fedo. Fedo. Over the past 11 meetings of the FOMC, not a single member voted against the actions of J-POW, an unusually long stretch of unanimity that belies underlying differences and uncertainty over the direction of monetary policy of the economy. All right, so they're basically saying, yo, usually there ain't this much consensus. What's up? Who's rigging it? Okay. But,
just close the fucking door. Close the door.
The policy consensus, which matches the previous stench of 11 unanimous decisions, has allowed the Fed to present a united front. That's part of the plan, yeah. Powell, way fewer dissents on average. We get the minutes Tuesday. Okay. All right. That's just a couple days before Thanksgiving. Isn't it weird that it's already almost Thanksgiving? It's bizarre to me. But anyway, he says, okay, so we'll get the minutes on Tuesday. Oh, well, that'll be cool. Okay, cool. So we'll go through the minutes for sure as well. And we'll cover that. But again, that'll be on Tuesday. Some people talking about Powell's frequent communication. It does feel like these Fed officials are always talking, always yapping. There's always somebody who's on deck to just send the market red when they need to. Although today it looks like we might have, not getting wood, maybe don't say it, a little bit of a recovery from yesterday. Yesterday, a little bit of red after the couple green days we had. By the way, I wonder, if how much we're going to see stuff like this. I'm going to show something on screen that I found. This is it says Affirm unsecured loan balance $1,500. Open date April 2022. On-time payments 4. Late payments 14. Oh. So basically, right as the Fed was beginning to raise rates, somebody here took out, maybe, I don't know if it was $1,000 loan or what at the time, but they have been late pretty much always on their Affirm loan for $1,500. 4 out of, they're on time 18% of the time. They have a B for being late because they're late 82% of the time. See, jeez. But I saw this and it just made me think, wow, how much of that is happening at Affirm? Affirm says in their earnings call, and I don't know if they're just full of crap, but they say in their earnings call that delinquencies are not at any kind of unusual or concerning level. Now, there's always the potential that they could just be full of crap and hot air. That's entirely possible. But I guess the easiest way to maybe do it is just go look at it really quickly. So we're careful not to extend consumers. Really? That's what they're saying here in their line. We're careful not to overextend consumers. Okay. Trying to, what do we have here? This is okay. Here's a section on them. I'm not sure that I agree the economy has deteriorated. Okay, so this is the CEO. That's a very broad statement. There is definitely signs. Somebody call the grammar police. I can't stand it. There is definitely signs of stress going as far back as April 2022. Hey, he's probably talking about this guy. No way. April 2022. Wait a minute. Holy crap. April 2022. It's this guy. Okay. All right. So definitely signs of stress going back to April 22. That's only speaking for our consumer. Not been a dramatic change in their ability to pay back their bills because they remain effectively fully employed. Obviously, the most recent unemployment numbers start to show some modest cracks in full employment, but still very, very strong relative to what we would consider to be a serious area of concern. And we tune our models to both. I don't know. Maybe it is just BS what this guy's smoking. Because, I mean, if you think about it, he's saying there hasn't been a dramatic change in people's ability to pay their bills. Maybe people were never able to pay their Affirm bills. Oh, yikes. Yeah, that's very interesting. Because in their earnings call, they brag to underwrite people for 6-month loans and 12-month loans. You have to be quite a bit more detail-oriented and thoughtful in your modeling. Really? Okay, look, I know maybe I'm being a little mean here by just showing one example here, but it's just a real example that I came across. And it was one of the first times I've actually seen this come up on, someone's profile. So it's funny, quite interesting to me. Late 82% of the time. And then Affirm not talking about things getting worse. So I just wonder how common that is, that like a delinquency rate. Maybe they have that in their investor relations. Let's go, like their quarterly report or whatever, just to see what the delinquency rate could possibly be, what they could survive with. I don't know. Might not get it. I feel like I'd be embarrassed to see. Let's see, what do they have here? So, Affirm's unique approach to risk management and our structural advantages recognized as durable differentiators relative to others, many of whom appear to be struggling with delinquencies in recent quarters. Wow. They're talking about their competitors struggling with delinquencies. Okay. Year over year. Oh, they do give numbers. Year over year comparison. Monthly installment loan. 30-day plus delinquency rate, excluding pay in 4. Wow. This is only, according to what they're saying, they're only at like 2 to 3% delinquent. I'll show it to you. I'll pull that up. That, I don't know. That seems remarkable to me. Look at that. Huh. That's really interesting. The company defines delinquencies as when a payment on a loan becomes more than 4 days past due. The company generally views delinquency in groupings of more than 30 days past due, more than 60 and 90 past due. Charge-off is considered after 120 days past due. Yeah, and then they just don't loan to the person again. Oh, yeah. Wow. They have an X Peloton. Oh, let's see if the Peloton delinquencies are worse. Oh, that would be funny if the Peloton delinquencies are worse than the standard delinquencies. So they actually do disclose all this. So hats off to them. Oh, that was cringe. I had to do it. Sorry. You could hate on me in the comments. It's fine. It's fine. I'm used to it by now. 2.4% now versus 1.4%. Oh, these are 60 days. Okay. 60 is only at 1.4, 90 is at 0.7. That's not bad because you're just going to charge off about 1%. Whoa. That's not bad. Okay. And then you compare that to X Peloton. Oh, it's actually about 0.1% higher on each of these. So a Peloton user is more likely to pay their bills than a non-Peloton user. How interesting. How can we affirm a serious recession is on the way? Oh, well, I'll tell you with whom you cannot affirm a serious recession is on the way. Who remembers T.S. Lombard? Who remembers them? TSL, the Bears. T.S. Lombard has a little bit of something to say to us. You know what they have for us? The Bears, folks. The Bears. Look at this. T.S. Lombard. No recession in 2024? Yeah, that's actually what they're arguing. They are arguing that in the old regime of hyper-globalization, domestic market deleveraging, and fiscal austerity, these elements have not fully kicked in yet, and therefore the next year is going to look recessionary, with nominal GDP contracting around the middle of the year and remaining thin. However, they're basically saying they don't foresee a recession, but if there is a recession, the worst case scenario is a technical recession, 2 quarters in a row of negative GDP, and practically you'd be something relatively thin or soft is what they're thinking. Unless they say, of course, something truly unexpected happening. That would be something breaking. So their base case is that the economy has entered into a new paradigm. Oh, that sounds very Ray Dalio. Very, paradigm shift. Anyway, Europe is already closer to the new trends, but leeway remains for the U.S. to absorb tightening through a faster turnover of money, protecting nominal GDP growth from a recession. Basically saying velocity of money is still too high. Even though it's low, it's still high enough to avoid a recession for now. And this is T.S. Lombard. They're generally very, very bearish. So I find it interesting that that they're not actually very worried about a recession. They think that if there is a recession, it's because inflation sticks around 4%, and basically the Fed doesn't loosen soon enough. But good question there, bringing up recession talk. So thanks for that. Reminded me of some research I had. I have like a tool belt, and then I just kind of whip them out like they're revolvers. I should do these streams with revolvers right here. Or no, slung right here. We got to get the cross draw. Should we do revolvers or should we do like Glocks? Or are we going expensive? Anyway. All right, so let's see here. Housing starts unexpectedly rise to highest level in 3 months. Wow, we covered that live as it occurred. Dollar's changing story has emboldened a slumbering bear case. What? Latest inflation and employment data confirm a softening in U.S. economic narrative and validate the dollar bear thesis. Oh, I see. Okay, yeah, here's the thing. When rates fall, the dollar should go down. Simple. So let's go to I don't know, you down. All right, let's see. Okay. Yeah, you up and you down are usually the ETFs I like to use, but this is very interesting. The Weeble does not want to display those. Oh, there we go. I figured it out. All right. You down. Let's see what we have here. Zoom out on the dollar. The dollar holla. There's the bottom in October of 22. Bottom on you down, bearish though. So that means the dollar was actually at peak when the stock market was at the bottom. That's when you had like real fears that Paul Volcker was going to come alive. So if I go to you up, you'll see that more appropriately. Here you go. So yeah, there you go. Peak dollar was somewhere around September, but we're almost at peak dollar right now. Wow, that looks like a tempting short actually. Wow. We're just now rejecting off some of those high levels. that we had on U up. That would be nice to short. I wonder how expensive these are to short right now. So if I go in for, I don't know, 1 monther, and I'm going to go for a put, I'll put it to somebody at, wow, $29. It's basically free. Yeah, I mean, you're paying pennies for that. Oh, well, the volatility must be pretty low. Theta decay is pretty low too. Wow. Ooh, but theta decay is going to eat away this one pretty quickly. I'd probably actually go here. I don't know. Would I? I probably wouldn't. I don't know. Anyway, or the other way to do it is you play calls on U down on the dollar falling. That's another thing you could do. You go calls over here. Calls at, oh, look at that. You're paying like next to nothing. And you got an open interest here, 433 on the 19. Oh, wait, sorry. I'm at, let me go back to December 15. Ooh. 0 to 10 cents. 1,200 open interest on the 19. Go for a little out of the money call. Costs you, call it 5 cents on average. You got some decent theta decay here, though. 10 cents. You're going to lose about 10% every 3 days that you hold this contract. So you better expect some quick volatile movement. That could be a little expensive. Might be better off just buying the shares then, or going further out. Anyway, here's Tesla, down 3.8% yesterday and turning negative for the pre-market here. We were up about 1/4 of a bip. We did see Treasury yields actually go higher again on the stronger housing numbers. Treasury yields were about to break 4.4, and they just popped back up to about 4.3, 4.44, or sorry, 4.43, 4.44. That's where we're kind of popping right now. We'll see what happens. Let's go look at the Qs here. You'll probably see that housing data come out in some red candles. Yeah, there it is. I mean, it's been volatile all morning long, but the housing data was right here. Well, that's a weird delay. That was like a 5-minute delay. Yeah, we'll get through that. It's not a big deal. Yeah. Here's the SPY. Also, about a 7-minute delay on the SPY. Interesting. Took a moment for people to really register that, I suppose. Oh, well. All right. Let's see what they're yapping about over here. What's this guy got to say? What do you got, Daniel?
Focused on the economy and worried about the economy. And thirdly, the oil exporters are, the Arab oil exporters are not interested in using oil as a weapon. They're interested in economic development. So those are the factors there. And as long as the war doesn't spread, the market is focused on these economic factors.
How does OPEC react to that?
Hey, can my favorite fans here give me a like, since we've got Simon here who says, here for my daily dislike. Why do you keep coming then?
Say, let's get through the first quarter of weakness and see where we are in the second part of the year. But this is these prices are not what they intended.
I guess the demand picture is the biggest wild card in all of this, slowing demand from China and other places around the globe. And while the economy is still very strong here, we're not seeing the same inflationary push that we'd seen before.
Well, I think that's right. And, the China reopening was a big factor. Oil demand up 2 million barrels a day this year. But China's only going to reopen once. It's not going to reopen again. So demand next year will be more tempered. And you're going to have this continual buildup of supply that really wasn't anticipated a year ago by many people.
But you get back to the point where you say this calm might not.
This guy's basically saying oil could plummet. This is actually very interesting.
Is that an outlier or potential of something that could happen?
Well, I'm not thinking, it's interesting, I'm not thinking of it in terms of base case. It's just probabilities. There have been something like 50 barrages by Iranian linked militias on U.S. forces in Syria and Iraq since October 17th. And so the question is, will there be some assault, some barrage on oil infrastructure in the Persian Gulf? Because that's the key thing, because 21 million barrels a day of oil pass through the Strait of Hormuz. And the country that has the most to worry about is a country whose leader has been visiting the United States this week, Xi Jinping, because China imports half of its oil through the Strait of Hormuz, and imports virtually all of the Iranian oil that now comes through the Strait of Hormuz.
That's interesting. I hadn't put that connection together. You think that's part of the reason that Xi Jinping is coming?
I think that that they have problems in their economy, which was demonstrated by that outreach to all the CEOs in San Francisco. And so to have an oil spike, a disruption, is not something that the Chinese economy needs. It's benefiting from U.S. sanctions on Russia, Iran, and Venezuela, because right now it's getting cheaper oil.
Mm-hmm.
Dan, your call, again, back to probabilities, and if you don't want to call it base case, fine. If you get back to probabilities, what would you say at the beginning of the next year? Where do you think things will stand January 1st?
Well, I think January 1st, I think we'll be still probably in a weak period, because that's when demand goes down. We still see over the year at this point, I would say that we still see oil averaging next year in the kind of the mid 80s. But, with all these uncertainties, because, who predicted on October 6th where the world would be on October 7th?
That's true. Again, though, people are looking to try and figure out what the next question is.
Well, that's interesting. At one point there, it seemed like he was thinking oil was going to come down, but now he's trying to, sounds like, almost stoke some fears about the Strait of Hormuz, which is interesting, because usually when you have these Israeli oil price disruption or Israeli conflicts, you actually don't have many oil price disruptions. Listen in for a moment longer here, and we'll talk about the bears for a moment.
See the U.S. increasing by 1 million barrels a day next year, which it did this year, but maybe 400,000 or 500,000 barrels a day. But that is what's, if you go to basically supply and demand, that's the key factors. This growth of non-OPEC plus oil being greater than the increase in demand.
Dan Yergin, very difficult to see how we got to this point in the oil markets, but I guess for now we'll take it. But thank you for your time. Have a good weekend.
Thanks.
All right, very well. Okay, so as far as there's a comment here which I think is brilliant. This idea of hey, like, if the bears are bullish, is that actually bearish? One of the reasons for that is you had Mike Wilson this summer say, okay, I was wrong. Mea culpa. I made a mistake. I'm actually turning bullish. And as soon as he did, as soon as that bear turned bullish, the market basically crashed. It was like that's what everybody was waiting for. So, yeah. Are the bears bullish now? I would not say so. You've got Morgan Stanley's still calling for the earnings recession via Mike Wilson. You've got, yes, TS Lombard is, I don't call them bulls. Remember, they're the bears that during the last rally said, hey, like, we're still bearish, but we're missing out on the stock gains here, so we're going to start buying some stocks. That's exactly what they did. I'm not even exaggerating that. That is exactly what they did. And it's so I have to kind of take all of these institutional opinions with a grain of salt. I like hearing them, though. I like hearing the other opinions. Okay. Let me post that really quick because one of y'all said that. There we go. Okay, cool. I just posted a little community post because somebody recommended it. Okay, good. So, but yeah, anyway, regarding some of these bears here, let's see what Michael Hartnett just released a piece. He says to sell the epic stock rally as risks linger is his take. His argument here is the S&P's recent low was reached on October 27th. And has been followed by a, quote, epic risk rally, referring to a broad advance in various different things. So not only yields falling, but also stocks rising broadly. Let's take a look at this. Okay, let's see what he calls an epic risk rally. All right, so this is our week chart on the SPY. And, okay, so he's talking about our bounce off the 100-day moving average. And then essentially this skyrocket right through almost that next fib. We're somewhat above that next fib right now. Okay. Small caps jumping. He's calling for people to fade the rally. B of A's bull bear indicator has flashed a contrarian buy signal for the past 5 weeks. That's the Bank of America. So HardNet works for Bank of America, in case it wasn't clear. Stocks have historically risen by a median of 1 to 3% from the start of this buy signal, which would represent a target of about 4,500 for the S&P 500 this time around. However, HardNet, who's been bearish all year long despite a rally in stocks, suggests fading anything above 4,500. The index right now is actually positive at 4,533. This is obviously SPY. This is an ETF. You can't actually own the indices like the S&P 500. You have to own an ETF, a vehicle that gets you that. ETFs are freaking awesome. The tax benefits of ETFs are just so good because it's basically an unlimited Roth if you had control over it. So, but if you could find one that rebalances the way you like, because they're expensive, like $500K a year to run one, then that could always be very interesting for a tax strategy as well. It's kind of like in real estate. I was talking about 1031s the other day, and somebody's asking me about 1031 exchanges in real estate. It's basically where, like, let's say you have a $900,000 gain on a home, and if you didn't 1031 it, you would go from $900,000 to $600,000 because you'd have to pay taxes. Well, if you 1031 it, you can move that 900 into another investment. Now you still have 900K. Well, having 900K is like having a 50% return on the 600K if you had to pay taxes and then reinvest. So, like, avoiding paying taxes at all costs is like one of the best things that you could literally do for your portfolio. It also makes sense because, you have this partner who always wants to take like 30 to 50%. And then if you actually have a partner on top of that, then there's another 50%. And then, I think Jordan Belfort has 3 partners. I think he's got the government taking 50% on restitution, which then taxes would be, well, I think he pays taxes first. So it's probably, if you make 100K, it's Jordan Belfort, and let's say taxes in California, let's call it 50% just for simple math. That's 50K. Restitution, 50% of that, that's 25K. And then if you're married and divorced after that, you'd go down to 12.5K. Damn. Could you imagine that? That would just be a string of bad luck. Anyway, okay. So, where are we? Let's see. Who's chatting? Who's this guy? What do you got, Matthew Miskin?
Strong earnings momentum, the best we can. Earnings tough to come by, but that quality factor to us is the best way to stay defensive.
By the way, how do you think about where interest rates are going to be as a function of all of what you're talking about?
So we do think that they peaked around 5%, but they're probably chopping around until we see more material weakness in the labor market. So if initial jobless claims continue to rise, which this week they did start to tick up, or the unemployment rate starts to rise, we think yields are going to crash lower, frankly. And so we're actually out of consensus thinking yields could actually come down more next year. They could be very competitive, the bond market relative to the equity market. But to us, within equities, you got to find the best companies you can to be able to wade this out, because bonds are going to look actually pretty attractive if treasury yields fall.
Yeah, dude, it's literally what I've been saying. It's like this idea of rates crashing. I mean, a little confirmation bias here, but let's keep listening to his argument.
Tom, a quick check on the markets right now.
Okay, well, they fired him. As soon as he went bullish, they fired him. That's very interesting. Let me think about what he said for a moment. Rates peaked around 5. You have to wait for the jobs market to start rolling over. As soon as the jobs market starts rolling over, you get a crash in yields. So remember what drives a crash in yields. I think that's very easy to forget how that works. It's basically people running out and buying bonds. As soon as people run out and start buying bonds, yields just crash. And it's great. Claims by U.S. Percentage of U.S. states with unemployment claims rising is below recession risk at the moment. for what that's worth. Oh, by the way, we did a great piece. I just want to pitch this. We did a great piece in the politics live stream yesterday, and I'm not bringing up politics here for politics' sake. Bringing it up because of this chart I want to show you. This is, let's see. Oh, where did I put it? There it is. It is 1116 screenshotter. Here it is. Yeah. This is what we just talked about a bit in the politics live. So remember, that happens at 9 a.m. California time every day the market is open. So Monday through Friday, basically. And so we came to this, which I think is very finance related. We thought if you have economic pain by November of 2024, which would include massive unemployment and a blaming of immigration, along with oil over 90, you have a greater chance of seeing a Trump win. Where if you have an economic boom by November of 2024, 24, if I didn't say that earlier, you might be more likely Biden, especially if there's less unemployment. I write that as UI, that's unemployment insurance. If oil is closer to 50 and you have higher stocks and asset prices, as well as deflation at the stores. Now, obviously, that's solely an economic argument here. It's not to be political at all. These are just to argue what are contributors to each candidate, right? So as we look at this data, do consider that as well as you're looking at the November 2024 election. And we did also in that politics channel talk about what I thought the implications of the election would be on solar subsidies. So if you're interested in solar subsidies, make sure to go check that out. Just type into YouTube, Meet Kevin Politics Live. I think it's great. And I try my best to just keep it very middle of the road. You know, I'm not trying to pitch an agenda. I have no political agenda. I really don't care. I want to just provide intel. So mostly because I think it's so interesting. There's so much fascinating stuff going on in this world, like money markets. You know, we briefly touched on this in the Meet Kevin podcast yesterday. All these things are linked down below. But U.S. money market funds, record $5.7 trillion. Look at that. All-time high. I wanted to y'all to see this graphically here. All-time high on the money markets. Bro, you know what this is, right? Let me put it this way for you. Okay, I'm gonna walk you to this answer. You should know this. You should absolutely know this. Okay, so rates, money market rates now. Oh, when I type I think millennial money. Oh well. So anyway, so money market rates right now are like 5.25%, maybe even a little bit more. So I want you to ask yourself, what happens? What if that drops to 2.5%, right? So that becomes a question. Okay, if we go to 2.5% on money markets, and at the same time, the stock market and bond market are going up as yields are coming down, what do we think happens? Well, I think basically all of this, I could kind of draw this floor. So we'll go in here and draw. Oh, I don't know. How do I want to do this? How about we draw a little shapey tool here, and we'll say that's your floor here of money markets, right? Everything above that floor, everything here, all of this is pent up buying power for stocks, bonds, and real estate. This is massive pent up buying power. And this is people who are uncertain, or people in institutions, which really institutions come down to people, right? So it's uncertainty, it's desire for short-term yield, although that's taxable yield, and it is pent up buying power for junk, boats, cars, planes, real estate, stocks, bonds, businesses, employees, everything. It is literally an economic cannon somebody's just ready to light, and you just get a really aggressive potential boom in the economy again when rates come down. There's no motivation to do anything right now because rates are so high. Well, less motivation. There is speculation, obviously, that, okay, well, they will come down, so therefore speculate on how to position on them coming down, which that's what I'm doing. But then again, I always feel like I'm like 6 months too early sometimes. 6 months is probably about right. Sometimes I feel like I'm 6 months too early, and then I have to like kind of wait through the pain a little bit longer. But that's okay. It's all right. The worst thing to do is constantly flip-flop. Yes, I had one flip-flop, a big flip-flop once. But the constant back and forth would probably be the worst for a portfolio. Anywho, okay. So how's Intel doing today? Holy crap, bro. Intel's at $43 halt. Bro, it basically got rejected by my next Fibonacci. Come on, man. I've been buying this sucker since basically around $30. If you want buy sell alerts, by the way, it's part of our stocks and psych group. We've got some new things coming out. It's probably not ready to talk about yet. Anyway, yeah, no, not yet. But anyway, stay tuned. So okay, so we've got Intel here. Let's see, how high did we go? We went to 43.40. The fib's at 43.92. Intel's a play, man. Let me see their valuation. The thing is, people are counting them out as basically a dead chip designer. I already assume they're dead as a chip designer. I want them to be a chip maker for NVIDIA and for all these other big boys who are like, we can't make them fast enough. All right, ready? EPS growth expected. Well, I'll go at the end of next year, $1.87. And then after that, we're looking at 35 plus 52.6. Those are growth rates expected for Intel, followed by 16.1. That's 103.7 divided by 3. 34% growth on EPS expected for Intel for 25, 6, and 7. That's more growth expected on earnings for Intel than Tesla expected by Wall Street. Okay. Then you look at their EPS end of next year is $1.87. Okay, they're a $43 stock divided by $1.87. They're trading for 23 times earnings. 23 times earnings. This is just quick math here. It's sloppy. Quick, sloppy math. It means they're trading for a PEG ratio of 0.67. Bro, 0.67. Holy crap. That's so good. That contrasts with, Enphase is obviously trading low, but that's because their growth expectations have been smashed. Trading for about a 20.4 times PE, but you're looking at growth of, let's see, if I go out over the next 4 years, yeah. Wall Street's only expecting 14% growth right now. So, you take 20.4 divided by 14, you're at 1.4. You're like twice the valuation of Intel at Enphase. So that shows you how cheap Intel is on growth expectations. Anyway, that's quick math. So, take a company like Apple. You can see the safety that's going on with Apple, or at least the perceived safety play of Apple. You're at 189.71. Boy, you got to be at all-time highs here. 659. You're at 28.8 times earnings. Wow, 28.8. And you've got growth expectations over the next 4 years. 28.8, 28.8, 28, 9.7. 28.8 divided by 9.7. 3x basically, 2.95. 3x on a PE ratio. So that shows you the extremes. Apple's trading for 3 times on a PEG. Intel's at like 0.67. Enphase at like 1.4. Wow. Okay, cool. What else? Somebody says SoFi. SoFi got an upgrade. Somebody wants to talk SoFi. They've been a volatile one, huh? Harsh little downtrend right here. It will be interesting to see if they end up holding the bag on some of these personal loans or if they're able to dump them all. So far, it seems like they've been doing a very good job of selling those high-yielding personal loans. And that's a great way for them not to hold a bag on them. They're able to make their money and move out. Do you see Apple's Black Friday sale? No. I want to see that. Let's see what we got. Black Friday. Sneak peek. Starting on November 24th, buy an eligible product and get an Apple gift card up to $200 to use on a later purchase. Get a Mac. Get a $200 Apple gift card when you buy a MacBook Air or Mac Mini. I don't remember them doing gift cards like that. I feel like they hadn't really done many big sales before in the past. Certainly not $200. Maybe $100. What do you all remember about Apple? I mean, it doesn't surprise me that the PC market feel like a little stagnant. You've got a $50 gift card on an Apple Watch, AirPods $75 gift card. $50 gift card when you get the Apple Pencil? Are you serious? Holy crap. Dude, the pencil's like $125. So $50 off. That's like 40% off. Oh my God. That's huge. No. Are you serious? That's insane. $75 off on the Max. That makes a little more sense because that's like a $599 product. So that's like 12% off. And then the iPad, if you get a new iPad, well, I guess you could get the $600 iPad and that'd get you about $100 off. That's also, that's like 18% or something like that. That's very interesting. No, I know it's a gift card to buy more Apple stuff, but you don't understand. If you're an Apple user, it is not if, it is when you will buy more Apple stuff. Apple definitely in deflation mode. Yep. Black Friday sale for the courses. Stay tuned. Let's see here. No, I get it. On your next, I get it. I just look at Apple. Like for me, I buy Apple stuff anyway. Especially as a business owner, we buy Apple stuff anyway. So it's like you're gonna end up buying it anyway. Somebody says, "True, true." My texts are blue. Oh, he's rhyming. Oh, what about Apple Watch Ultra? So I have the Apple Watch Ultra 1. Dude, where did I put it? Oh, it's in my pocket. I meant to put it on the charger. I have the Ultra 1. I actually really like it. I enjoy it. I think it's a great watch. I don't know if that'll ever... Oh, that's just showing the code. But anyway, this is mine. I love the little button because I use it as a flashlight. Like, so I don't wake up the twins or whatever in the middle of the night. Or like sometimes I'm in the car and the kids need... what's it called? Like a light to put their seatbelt on because it's getting dark earlier now. So I could just... Here you go. And I kind of just use my wrist. That's also because lately I've been wearing my watch on my right. You got to keep the tan lines even. I'm also honestly trying to bother my son because he refuses to wear his watch on his right wrist. So now I'm only wearing it on my right wrist. Yeah. Okay. Anyway, so where were we? All right, let's see what's going on with the market. Dang it. Talk about the market, Kevin. Stop talking about this other bull crap. Fed Collins, an increase in labor force participation can ease imbalances between demand and supply. No. It's supply and demand because otherwise, when you're drawing the chart, it's always supply and demand because if you draw it as demand and supply, that's dumb shit. See, get it? Oh, sorry. That's like an old econ joke. Anyway, so if labor supply expands to meet demand in tight labor markets, then higher levels of economic activity in such times may not generate additional price pressures. We're not seeing additional price pressures. Again, exception of aviation and ski resorts. Other than that, people are panicking. I do suspect that this Apple Black Friday sale is bigger than usual. Let me see if I could get what the suits are saying on it, because that I don't recall pricing being like that. Apple plans to kill SMS next week. What? Apple Watch Ultra 2 drops to record low of $739 in early Black Friday price war. No way. Apple Insider. Apple Watch Ultra 2 is on sale for $739. Honestly, that's high for a watch. Like it's a little high. You know, that like $599 is already getting a little stretchy, but $739 with tax, you know, I'm sitting at like $800 then. I don't know, man. If you're looking for a great gift idea, blah, 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 whatever. Apple Insider. Okay, whatever. Interesting. So they're talking about a price war. We already know about iPhone price cuts in China and India. Past few weeks have been jam-packed with early Black Friday deals. Now that the shopping holiday is just 1 week away, we're going through all the best sales we've missed so far this month. Remember, Walmart actively talking about deflation and lower prices this year than last. I want to do some on-the-ground reporting again for Black Friday. I remember I went on-the-ground reporting for Black Friday, like a year or two ago? No, it was last year, and they had like TVs stocked everywhere. And I'm like, oh no, here it comes. Prices are coming down. And sure enough, like the TV market cratered. We originally tracked the AirPod 2s for $69 at Amazon in early November, but that sale quickly expired. Now you can get the AirPod 2s for $99, down from $129 at Apple. AirPod 3, $139, down from $169. The Max is sitting at $449 on Amazon, down from $549. Wow. And those are good. I like those headphones. Let's see here. The phones, they're trying to keep their margins by basically selling you on the discount plans with the like AT&T, with the carriers, with AT&T and T-Mobile and that. Very interesting. All new low price for the Watch 2. The accessories are all on sale. Wow. Apple Watch magnet charger down to $34 from $79. Oh, man. The deflation's coming. Let's go. Apple AirTags, $86 for a 4-pack, down from $99. Okay. All right. Interesting. Okay. Yeah, I got AirPod 2s for $69. Good job finding that. That's awesome. Very, very good. Daily dose of the meat, Kevin. Like, oh, thank you. Thoughts on the humane AI pin? Dude, that seems honestly like the most stupid thing ever. But what's so funny is they're getting so much hate that they're almost going viral. Well, they are. Like, they're Steve Jobs impression video and just like how stupid it is leading people to actually buy this crap. This thing. AI pin starting at $6.99. It's like wearing a body cam and then having like some dumbass projector that projects to your head. It's like the most stupid thing I've ever seen in my life. It is so dumb. I please, like, if you're going to throw away $699, give it to a charity like that you don't even like. Let me put it that way. Give it to it. That was the rest of my full thought. Okay, is I don't think giving money to charity is throwing money away, but give it to a charity you don't like. That's my point. So like, I don't know. Like if you hate the ADL, give the ADL $699 before you buy that. It's so stupid. Whatever. Sorry, that's just my real thought. This is, and I think there was some drama going on that they're charging, $14 for shipping too. Yeah, it's so dumb. I'm sorry, I can't handle it. Let's see here. Put it in Apple stock as well. instead. Yeah. There you go. Tesla dump today. Lots of negativity on Elon's comments. Yeah, well, I mean Elon's comments, that drama, I think was mostly priced in yesterday, but we also had kind of a give back yesterday. So I'm not horribly thinking that more of his price comments have to get priced in today. I think people are used to Elon just being a knucklehead at this point on the stuff he says. I don't know how much more hate he could really garner. Like, actually, he's already done a good job at acquiring hate, which is fine. Like, to each their own. It's just sad for Tesla shareholders. It's sad for Tesla employees. So, it's going to be something that just has to be dealt with. But let's see. I mean, Tesla stock right now, how are we doing? Tesla is sitting, it's down about 0.8% right now. Let's listen to CNBC. What do they got?
You were hired to sell. And this makes it a tougher sell. You call these guys today and say, listen, he didn't mean it. But then you have, they said, we don't care.
Yeah, we don't know. At some point, you just
We don't
say,
care whether you mean it or not.
right, enough. Right. Doesn't matter what you may
Is
be.
he a genius? Yeah, but I don't have to advertise next to him.
We're not done talking about it, obviously. It's
That's about Elon, actually. Perfect timing.
look at Kramer's Mad Dash. Countdown to the opening bell. One more look at futures on this Friday morning. Don't go anywhere.
I love that sound. It just reminds me of the COVID days. It's so crazy. If you look back at like all the crap that's happened since COVID, isn't it weird to think that it's been 3.5 years since the COVID, the start of COVID? It's so weird. Actually, even a little bit more than 3.5 years at this point. Wow. It's just, it feels like 10 years were compressed into 3.5. It's very, very weird. I don't know. It's funny, I was meeting a software dev that we were interviewing. I met them. I guess Orange County's blowing up with software devs, by the way. But anyway, I was meeting a software dev that we were interviewing for what we're doing, and this was like I don't know when this was. But anyway, after I met them, they're like, "Oh, by the way, I got COVID," and I'm like, "Oh, great." And so I told Lauren, I go, "I don't know, like, be careful or whatever." And every day I've been waking up, I'm like, "Do I have any symptoms?" And Lauren's like, "Kevin, like, I don't want to say it, but like, I'm not worried. Like, you're basically immune to COVID. The family has had COVID 4 or 5 times, and you've gotten it 0 times." And I'm like, I'll take it. Knock on wood. But like, it's still a thing, it's so weird because I haven't actually realized or like, it doesn't seem that common anymore. I don't know what's everybody else's experience with that right now. Anyway, so, okay. US housing starts unexpectedly rise. Okay. We already read that. Wall Street bosses turn to AI to help write performance reviews. Oh, wow. Okay. Hey, GPT, write a performance review. Oh, you have 100 employees and it takes 7 hours to write a job description. So 700 hours, hypothetical example. Now it takes 2 minutes. You do the math. It's a productivity gain. Yeah. GPT is amazing, for many things. There are definitely some things that are not great. One thing I found is, at least for me, some people find it useful, but getting very specific rules from GPT, not that great, because it likes to conflate rules sometimes. It's like, oh, well, it's probably this, and it doesn't give you exact answer. But it's learning. I like that they've updated it to April of 2023 or whatever. So we're getting some more current data now. Very exciting. Anyway, okay, so let's see. Fallout from Elon Musk's anti-Semitic nonsense comments here spread. He shouldn't have done what he did. Miami inflation index ranks highest in U.S. as newcomers pour in. Okay, so this is very interesting to me. A lot of people going to Miami as a tech area. I absolutely despise Miami. So I'm going to be clear about this. As a former Floridian, I spent 16 years growing up in Florida. I absolutely love parts of Florida. Fort Lauderdale Beach is amazing. South Beach is amazing, which is part of Miami. Aventura is amazing. You want to live in one of the best places, if you're going to live in Florida, Weston Hills Country Club, or just Weston Hills in general, master plan community. You want to be on the West Coast, one of the best places to live, probably, quite frankly, Clearwater. Absolutely gorgeous. You could go knock on Ben Mala's door. Hey, You know, there are a lot of cool things about Florida, but Miami itself, Brickell is getting nice, like one street, but then you go like 2 streets out, and you feel like you're gonna get mugged. You feel like you're gonna get robbed. Like it's scary. Let me put it this way, okay? I've probably looked at 500 properties this year, and only one time I go meet a real estate agent just outside of Brickell, like 2-minute drive for Brickell. 2 minutes outside, I go meet a real estate agent, a lady, and she has this dude coming with her who's like her bodyguard. Like, oh, hey, you an agent too? He's like, nah, man. I'm like, okay. The only place I've ever met a real estate agent who basically brought a bodyguard. I'm like, that's Miami for you. No, I can't stand it. I couldn't do it. I know a lot of people that are moving there. I mean, you can get some nice properties on like the intercoastals and stuff if you're like a billionaire or whatever. But no, hot, muggy. If you're on the beach, it's okay. That's the only way, though. I don't know. No thanks. I've been there too long. Maybe I'm just jaded. Anyway, so we're just a few minutes here from. But anyway, I was going to keep going. We're a few minutes from the bell, but I'm going to keep going with this. Miami's annual inflation rate of 7.4% in October was the highest of U.S. metro areas, more than double the national average. Tampa stood at. What do we have here? Tampa. Where is it? I just lost it. How do I lose it? More than double. Tampa stood at 6.7%. By comparison, Phoenix and Atlanta have seen their rates drop by 3%, despite being a hotspot last year. Much of the stickiness in Florida appears to be driven by people and businesses relocating to the region, boosting spending and demand for homes and energy. Yeah, if you are getting business, like, look, Kathy went to Tampa. When I met her for dinner, she said she didn't want to move to Miami because so many other businesses were moving to Miami. And so she wanted to have her own influence in her own area. So she chose Tampa, like St. Petersburg. St. Pete's pretty cool. I like Tampa. And yeah, anyway, remember, like, home prices and this sort of inflation is driven also by job availability. Like, I hate LA. So, you know, some people like LA. I think LA is trash. I think LA is worse than Miami. But anyway, like, people go there because the jobs are there. That's what people want. People want jobs. And so jobs support everything. So, you know, sometimes people wonder, they're like, how do people afford these rents? It's impossible. It's like, well, it's because there are higher paying jobs in those areas. You know, there was this person absolutely drove me nuts on Twitter. And you know, this is the thing about, well, Twitter or X, whatever you want to call it. What drives me nuts is when people take things completely out of context, which they always do on Twitter. It's, I think, one of the worst for it. Don't get me wrong. I'm not just trying to do like an Elon bag here or whatever. I'm just trying to be honest about this girl's tweet. But anyway, I'll pull it up. But so she, I can just pull it up right here. She's tweeting basically about how bad home prices are in Boston. She's like, oh, I can't find anything under 10 grand in rent. I can't find anything. Help. This is horrible. How's anyone supposed to survive in Boston? It's impossible to survive in Boston. And nonstop complaining in her entire video about how expensive Boston is. And here's, let me see if I can pull it up. Let's see. Can I get video on this? Do we have audio? Not that one.
Nation's apartments in Massachusetts.
Oh, well, hold on. We're about to get the bell. Let me hit the bell and we'll come back to that complaining. I also don't know why it cut away, but that's okay. I'll fix that in a sec. Yeah, let's get the bell really quick.
Kissinger saying it really is important that we bring this back down. And Kissinger knew more about China, I think, than anyone knows more than anyone in our lifetime. And I thought that that's what really happened. I mentioned earlier in my memo that it was, and on Twitter, that there was not a lot of business done.
Let's go.
What was the step back. And I remember, for those who are old enough, the step back from when Russia seemed like they were on a nuclear warpath with us was very good. And I think that this was very good that there was a step back. I don't think anyone gained an advantage. David, we didn't even get hot.
Okay, all right. So there's our opening bell. I'm curious quickly to see how the market is opening. But, well, Tesla's down 1.5%. QQQ's dropping. Straight down. Well, you know, like, I find it so interesting, the volatility. It's like, why? Oh, what? Daily's talking. Daily. Fed needs the boldness to wait. High risks and murky economic conditions mean Fed should practice gradualism. Fed needs patience, measured adjustments. This literally got released at 6:30. So this is fresh off the press. Fed uncertain if current economic dynamics are now remnants of a pandemic recovery or a new normal. Not certain if inflation is on track to 2%. Unsure about the length of policy lags. Now focused on what constitutes sufficiently restrictive and how long to maintain that. You know, this is the same crap every freaking day. I'm tired of it. And it's the same crap. Anyway, bond market is still down about a bip on the 10-year. 2 years actually up. That's not great. That's probably why you're getting the sell-off when you get that sort of steepening of the yield curve. Anyway, all right. So yeah, listen to this trash. I mean, whatever. Okay, here we go. You ready for this? It just pisses me off. Wait, I can't hear it. Why can't I hear it? Dang it. This should be easier, Kevin. This shouldn't be that hard. Huh. Interesting. I had it. I've lost her. All right, whatever. Basically, look, here's the thing. You've got, like, you know, a pretty girl goes on social media, and so everybody feels bad for her. And then the idea is, hey, why is it so hard to get an apartment in Boston under, you know, $3,000? Like, your studio's trading for $10,000 or whatever. I'm going to try one last time. Play. Okay. No, I'm screwed. Why? All right. Wasn't meant to be. Anyway, yeah, so she's talking about, she's got the creepy music going. And the pictures she shows are all new construction. It's all new construction stuff. Like, downtown Boston shows all the highest quality buildings in downtown Boston and says there's nothing available for her. That instead, look at this. It's $15,000 for their luxury apartments. She's like, no, they're not. They're not luxury. They're not luxury. They're brand freaking new in downtown Boston where there are a ton of jobs. She says, oh, it's only a 2-bedroom. It's a little box. So you get that in Manhattan as well. And the reason is because of the jobs. So I replied, and I replied the following. I go, bro, I don't know. I'm like, oh, it's the HDMI is just like dead or whatever. Whatever. So I reply and say, bro, she's just lying. All of these, and I put up a little screenshot, are under $3,000. All of them. She's showing luxury construction downtown. And I show this, you know, this sort of surrounding area, which is what she's talking about, saying there's nothing available. And these are all under 3K. 2.9, 3K, 2.7, whatever. Plenty of other options. Now, on the flip side, there are a lot of people who are like, but Kevin, 3K is a lot for rent. And I'm like, well, you don't have to live in Boston. Then go move somewhere else. But if you want job opportunities, they're going to be, you know, Boston's got lots of jobs. That's why the rents are higher. So, like, on one hand, people can complain about it all day long and say, but Kevin, that's expensive. That's fine. You're right. It is expensive. Do you want to play the game or not? If you don't want to play the game, Chillicothe, Ohio, and you can play the game there. Let's see. Let's see what it pays. Let's see. How much money can I make in Chillicothe, Ohio? Let's see here. How about I gotta figure out how to spell it first. Chillicothe, Ohio. Job. Okay. All right, here we go. YSK Corporation, quality staff engineer. Okay. So you ready to be a software engineer? What is this? What is quality staff engineer? No degree, health insurance, try individual platforms, work on our systems. What is this stuff? This is anyway, here's an engineering job in Chillicothe, Ohio that'll pay you $43,000 to $57,000 a year. Okay, here's another one that'll pay you $100 to $120K a year. There are 2 software engineering jobs available in Chillicothe, Ohio right now. One will pay you an average of $47,000. The other will pay you an average of $110,000. Okay? Now, if we did the same thing in Boston, let's see what we get. So Boston, they don't even list the prices. Probably because it's all insane. Oh my God, but there are a lot of jobs. Holy crap, there's so many available. I think just on scrolling here, there got to be like 50 software engineering jobs available, or 100 or more. Oh, it's way more than that. This just keeps going and going and going. Oh yeah, no, these are all like 150 to 250K jobs. So way higher pay, way higher availability of jobs. So you can't really complain. It's pretty obvious. But anyway, so, okay, good. What is staff? Staff, like QA? Yeah, but anyway, like if you're a staff engineer, you're going to get paid twice that if you're in LA. Point is, the high cost of living areas are going to make you more. Okay, so what else? What else? Even nurses and firefighters and stuff like that, they make more money too. But yeah, some jobs you're just not going to be able to live in the city, right? Look at Monaco. Okay, I'll give you. Let's go the most extreme possible. Okay, Monaco median income. Okay, so the median annual income in Monaco is $186,000. Okay, it's its own little country. It's a tax haven, so you get a lot of like basically wealthy people that go over there. It's by the French coast, so it's beautiful, Mediterranean. Gorgeous area here. It's by Nice. So Monaco, most people who work in Monaco at the casinos, at the ports, firefighters, cops, teachers, they don't live in Monaco. They live in France. They live in the outskirts over here because they can't afford to live in the city. That makes sense because look at the city. It's absolutely gorgeous. You do, Formula One races over here. This is insane. This is beautiful. Mediterranean coastal city here. It's crazy. Anyway, probably not a place to raise kids though. I think a lot of people go there to retire. Anyway, so okay, that's my rant. So let's go see how the sticks are doing. They're going straight down. Oh yeah. It's just like so classic. You get, nice little Fed, got to push the 10-year back to 4.44. It's the volatility. Ray Dalio says the U.S. is reaching an inflection point where the debt problem quickly gets even worse. Ray Dalio, who's been talking about the end of this cycle, that we're in the 9th inning for like 5 years. We've been in the 9th inning for 5 years. Crazy. Anyway. Oh, I know some people call it Monaco, whatever. It's because in Germany, that's how we say it. Okay. I used to that because of family. Get over it. Relax. Take the stick out of your ass and comment on something else. Make the stocks go up instead. Please go buy some stocks. Go buy the dip so we can pump my portfolio. Okay. Thank you very much. Anyway, so let's see here. We've got Palantir's green. Oh, look at that. Palantir over 20. You've got NVIDIA. It's red, but it's still sitting at 492, almost at 5. Amazing. Hasn't broken through that yet. I don't think we've broken through once on it, have we? Let's see here. Oh, we did. For a brief minute there, we broke up to 501.89. That's really interesting. So then we've got Matterport. Small caps are risky. I remember when we were first thinking about going into a recession, there was this thought that maybe small caps might be something to look at. The problem is rates are so high and they disproportionately affect smaller companies. Massively and disproportionately affect smaller companies. The problem with Disney is they're so indebted. Who did we look at yesterday, by the way? Their stock's actually done well over the past few days. Since their earnings report, they're breaking that down. It's actually on a TA basis. Disney's looking good on a TA basis. It's almost looking like it's bucking that downward trend right here. So that's not bad. But who did we look at yesterday? Oh, we went to the Walmart earnings call. Oh, yeah, that was like pure deflation. Walmart has so much debt. The amount of debt that Walmart has is quite frankly scary. They have so much debt. I actually think they don't have a lot of runway left with how much debt they have. It was very bizarre. Wonder if I have that convenient here. Earnings. There's the earnings call. I was hoping to get their earnings report. Yesterday, I sort of reorganized some stuff. I messed things up. Oh, yeah, here it is. Look at this trash. Look at this. This is what I wrote for Walmart. It's so tempting to short because deflation will reduce free cash flow and their debt's high. This is the kind of stuff we do in the course member live streams, by the way, which the next one's in like 3 minutes. If they cut their dividend, their stocks fall. Their stock falls. EPS will weigh down on deflation and debt payments. Euphoria on stocks could be something that makes shorting Walmart risky. But they're warning of deflation on inventory. They've got about, with my quick math, about 70 bill of current assets. They have about $32 billion of cash more than they have in bills, but they have another $36 billion of debt. I'm sorry. They need another $32 billion of cash just to pay their bills. So they're out of cash, which explains why they're literally borrowing to pay their dividend. And then on top of that, they have, another $36 billion of long-term debt. I did not like what I saw on the Walmart numbers at all. Scary, scary, scary. Share of Americans who are mortgage-free hits an all-time high. Oh, isn't that cute? It's like 39%. Oh, that's nice. Let's see here. Okay, we got the Fed update. Let me see what else there is. Oh, Biden signs the bill averting government shutdown. Okay, very good. Oh, well, Walmart's not going to go BK. No. It's certainly a blue chip, but it's I think they're. Let's just say mark the calendar for the next year. I'm not very optimistic on that one. That's my take. So let's see here. Okay, we have Barr supports SEC proposal on central clearing of treasuries. Fine. Let's see quickly what other Fed updates we had. We talked about Murray Daly. We've got Collins. If labor supply expands, more growth may not boost inflation. We know that. Effective Fed funds rate 5.33. Not pricing in more pain. How about the 5-year break even? 5-year break. Let's see what we got over here. 2.22. That's good. 5-year forward break even is 5-year forward sitting at 2.32. Both of them down substantially over the last 6 months, which is fantastic. In terms of up, we've got Macy's, Etsy, a lot of consumer stocks here. Macy's consumer, Macy'sbill.com. You've got on the down, Tesla, 2.5% down. Microsoft, Alphabet. Looks like the big 7 are down. Anyway, I got it now.
Just close the fucking door. Close the door.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage the ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Boom! There you have it. I got to go live in the course member stream. I forgot to send the link. I'm going to do that right now. I'll see you all over there. I'm going to go live. I'm going to press live some more time. Bye, everyone. Love you.